A brilliant product built on top of a weak legal framework is a liability waiting to collapse. In the US market, personal wealth and business operations share a fragile wall from day one, and without a barrier, any legal threat to the company is a direct threat to your own assets. Many founders fall into the trap of this sole proprietorship. It is easy to set up, but it offers zero legal protection. If a sole proprietorship is sued or incurs massive debt, the founder's car and private bank accounts are fully exposed to cover the loss. This architectural blueprint shows how a limited liability company, or LLC, acts as the essential baseline shield. It legally severs your personal assets from your business assets. If the business fails or faces litigation, the damage stops at the glowing barrier of the LLC. While an LLC is the standard, a C corporation is a heavier structure that subjects the business to double taxation. You only take on the complexity of a C Corp if you plan to raise capital from institutional venture capital firms, as they strictly require this specific corporate entity to invest. Launching without establishing the correct legal shield on day zero means you aren't calculating a business risk. You are recklessly gambling your personal life and future on a prototype. Once the legal barrier is up, survival comes down to financial literacy. Staring at raw cash in the bank account creates a dangerous illusion of success. You have to separate temporary cash flow from actual, sustainable profit. This dual timeline Gantt chart illustrates accrual accounting. Most US businesses use this method to survive large contract cycles. Instead of logging income when the check clears in month 3, you record the revenue in month 1, the exact moment the service is earned. To test a company's operational health, investors look past the cash and use a metric called EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. It strips away the complex accounting rules and tax structures to reveal exactly how much money the core business operations are generating. Mastering accrual math and tracking your EBITDA keeps you grounded in reality. It prevents you from hallucinating long-term success just because a large, temporary invoice finally hit the bank account. Once the legal entity is filed and the minimum viable product goes live, the game shifts. The priority moves entirely away from theory and focuses purely on ruthless operational efficiency and scale. This bar chart measures survival. The red bar is customer acquisition cost, the price to convert a new buyer. The green bar is lifetime value, dwarfing acquisition costs. If acquisition costs exceed lifetime value, your unit economics are mathematically broken. Modern US businesses survive this math by utilizing an operational stack. They integrate automated software-as-a-service tools and sophisticated customer relationship management platforms to squeeze inefficiencies out of the pipeline and artificially force that acquisition cost down. Scaling up marketing spend without positive unit economics and tight automated systems doesn't build a massive empire. It simply accelerates your path to bankruptcy. As the company expands and begins to hire, it enters a highly litigious compliance minefield. The operational leniency of the early startup days slams shut. You face strict legal lines regarding the people you pay. There is an unforgiving distinction between a W-2 full-time employee who requires benefits and tax withholding and a 1099 independent contractor who operates with distinct autonomy. Treating an employee like a contractor to save money triggers massive US federal fines for misclassification. These penalties are severe enough that they routinely bankrupt scaling startups overnight. At the same time, the assets you build must be protected. You construct digital moats by locking down your brand authority with trademarks and shielding your unique technology with patents before competitors can legally duplicate your work. A single operational oversight can trigger devastating legal penalties, instantly erasing months of hard-fought revenue. If you survive the compliance minefield, you are hunting for product-market fit. This is the rare, chaotic inflection point where consumer demand violently overtakes your startup's capacity to supply the product. Looking at this line graph, managing hypergrowth requires tracking an existential balance. The descending line is your burn rate, representing the cash you lose every month. The horizontal axis is your runway, the number of months you have left before hitting the exact point where the bank account goes to zero. To extend that runway, founders face a choice. They can rely on bootstrapping, surviving purely on incoming sales revenue and personal savings to slowly scale the operation without outside interference. Or they seek external fuel. This means either taking on the rigid, mandatory payback liabilities of debt financing or selling off pieces of company ownership in exchange for equity funding during a seed or Series A round. The choice of fuel permanently alters the trajectory of the business. Bootstrapping, taking on debt, or giving up equity dictates exactly who controls the ultimate destiny of the company. When you take institutional money, the clock starts. U.S. investors do not inject millions of dollars into a company merely to watch it operate profitably on a steady timeline. They demand a definitive mechanism to extract their multiplied capital. This is the exit strategy. Wealth is realized through two primary paths: selling the company outright in a merger and acquisition, or taking the company to the public markets through an initial public offering. Every chronological step we've covered was an exercise in reverse engineering this moment. The Day Zero LLC filing, proving positive unit economics, and maintaining flawless W-2 compliance were all strict prerequisites designed specifically to pass a final acquirer's brutal legal and financial audit. Scaling a company requires constructing an operational asset with the precision of a tradable commodity. Every metric and legal safeguards ensures that by the time a founder is ready to leave, the business is a polished, verifiable product ready